a lot of the people working in the startup ecosystem will create wealth via ESOP. That is the most important asset that they are owning.
How do you think about founder salaries?
I was earning a 1 crore salary then, and then within a year of starting the business, my first salary that we took was 25,000 for two of us.
So, for first couple of years, it was bootstrap. So there was no salary.
People make the worst decisions when they see large amounts of money, right? Because हाथ में पैसा आ जाता है, suddenly you start feeling very nice.
This founder who's done secondary is a wealth manager's delight and a risk manager's nightmare.
I think maybe we'll start with Deep and Mohit. Maybe a little bit of journey, maybe 30 seconds to a minute on what was your financial situation when you started the startup?
So I was in McKinsey and Snapdeal at that time. I was earning a 1 crore salary then. I thought I had saved up enough. And then within a year of starting the business, I had sold 2 houses and put all of it in starting the business. So I was very mistaken about how comfortable I was.
And I've always been in business. So for me, I didn't even think this much actually. What did I start with was nothing. And what do I have today also is nothing. It's all managed by
That's
my
you
brother.
being modest. But would it be fair to say that around more than 70-80% of your net worth would have been in your business when you started?
It wasn't 2 properties which I sold, and then it was in the business.
Yeah, it was all in.
Yeah. So I think founders face this unique problem of, where upfront you have to invest a lot, but then you're hopeful that over 10, 15 years, you sort of make a lot of money. How do you think about venture funded? You have been venture funded. You also...
I raised after a couple of years.
Some money, right? Yeah. How do you think about founder salaries? How much should founders draw? What is the philosophy around what founder salary should be? I know we have a very different view as VCs.
No. So I'll give you both perspectives as now VC at DVC and earlier as a founder myself. So the logic we used was I was always paid slightly lesser than my top paid employee at every round of funding. We went with that because we felt that, look, there is something that you want to give. You really want to show and give the investors that, I'm really all in on this. But I shouldn't be worried about at home and running my house. So I need something. My first salary that we took was 25,000 for 2 of us. Our top paid employees then was 35,000 a month. And then as we ramped up pre-sale, I think the top paid employee was probably 70-75 lakhs an annum, and we were at 60.
So, for the first couple of years, it was bootstrapped. So there was no salary. And then as we raised our small angel round, how we looked at it was, what is the least amount of money that I need to survive? And then that is all that was available. And I also looked at it from another point of view saying, this money that we are raising is against equity, So there's no point selling it's like selling blood and taking that money home. So what the least amount was parked aside back then because I could survive on that. And as we grew, we started incentivizing ourselves with revenues. We said when we hit a 1 crore, then I'll take 1 lakh of rupees because the business can afford it. So it was never, at least in the initial phases, linked to funding. It was linked to revenues. And starting point was whatever is the least that I need. But having said that, I think the least is very different for each founder. So what I tell all the founder friends that I have, I think you should raise the amount with which you can sleep at least peacefully. You shouldn't be thinking about where am I going to pay the salaries, in the sense fees from. If you have kids, your priorities change. Back then, we didn't have those many expenses also. So the advice, at least that I give my founder friends, is you please figure out what is that amount, and that amount could be very different. I'm nobody to judge it.
Yeah, I think it's the same. As an investor, I've realized that I am extremely greedy, but not for money that the person takes home, but more for their time and attention. Right. So what we would love to see is founders who are giving it their all, and founders can't give the business their all if they're worried about bills at home and what do I do and worried about school fees. Right. So you should never be in a situation where you have to worry about the basics. Yes, you may not be able to afford to have fancy cars to take to the racetrack as founders. That's not the intent. But, as long as you're not worried about stuff at home, and if you are worried, then you should just speak to your investors and sort it out, right? Very few of them will say, no, right? You figure out stuff on the side, but you can't take more.
I agree with you. I think at least at Z47 and in general in the VC ecosystem, nobody wants founders to be busy figuring out their personal life. on expenses, right? Like you don't want your founder to be struggling to meet basic things like rent, school fees, a lot of things, because a stress at home can come to stress in your company, and that's the worst thing that can happen. So if you've raised enough money, we are actually pretty okay with you taking, with any founder sort of taking whatever is the basic need. In many cases, there are different models. Some people say cost plus, whatever is my expense, I'll take some part of that as money. Some people benchmark it to their past salary. They say I was drawing X, I want to take 25% of X or 50% of X. It also differs in the nuances where you are in your life stage. A lot of people make money and then start up. And in fact, it's very funny. The people who actually made a lot of money take their salary to zero. And you should talk about how you thought about Soika. Those are two unrelated things, but a lot of experienced founders who spent 10, 15 years in the ecosystem and have had one stint of a founding team or a deep corporate career, which has sort of given them a healthy enough nest egg, they try to draw from that and keep the salary minimum, because you have to realize that every rupee you take of the company is reduction in future valuation, right? Because you are cutting the company's earnings that much. But younger folks generally don't have that kind of nest egg, so they tend to take more, but they also don't have much expenses. So it's a delicate balance. Why don't you tell us, how did you think about, you are, to be fair, earning a couple of crores, how did that?
Not right now, but no. So actually, there is, I've been on the other side where working with a lot of founders on their personal wealth situations, and then obviously having been one. One common thread that I see is that founders are generally shy of talking about their compensation. Like the fact that they feel almost like, why I should not take salaries, almost going in the default, right? But then there are three questions that I think every founder needs to answer. First is why, when, and how much. Like, and I'll explain what I mean. Why do you need a certain compensation? I think to the point that was made, I think the fact that your family should be comfortable, because if your family is comfortable, you can focus at work. Otherwise, you're constantly looking over your shoulder and worrying about that, where will the next fees come from? Is my parents' healthcare covered? And so on and so forth. And you don't want to be in that situation. That's not great for the company. When is the question of when should the salary be reset or reevaluated, etc. And to my mind, I think that's at a capital event, because the founder's core job and reporting back to external investors or to the team members is around the fact that, am I creating shareholder value? And if I'm creating shareholder value, so there are up rounds that are happening over a period of time, those are natural checkpoints at which the salary can be reevaluated. The third is the question of how much. And I think Mohit laid out a principle which is lesser than the top employee. To our mind, the way we have taken looked at it is that what would a similar sized company employee be compensated? And we have chosen to do 40 to 50% of that as being the threshold that we will apply to ourselves. So I think how you rationalize it, all of that is everyone is different, but I think you should not be shy about it. Having said that, there's one caveat, which is that if there is a downturn, if there is an issue, the founder's salary is the first that usually gets readjusted and should be, right? Because linked back to the price of the share, if in a way during downturn a company is not doing well, things are going bad, the founders will have to take the first step back.
Yeah, and to be, not to be pessimistic, but I don't think it happens as much in the Indian startup ecosystem. I think we do have, first is we don't have these conversations openly enough, saying what is my personal financial plan going to be, right? Because as VCs, we are okay with founders taking lumpy bonuses, like you said, right? If you hit a certain capital raising event, or if you hit a certain profitability event, or if you hit a certain revenue, we're completely okay, because we realize that for the first few years you've sacrificed. And if you're creating equity value, then there's cash coming into the company, you should absolutely have that conversation. How do you think about ESOP liquidity? And you've maybe you can talk about, Mohit made an important point that it sets the price. And a lot of ESOP liquidity has happened over the last 2-3 years in the Indian ecosystem. It's maturing. You see a lot of people actually seeing money to the paper value. How has it affected employees' morale? Have you seen it? And what is the way to do it? Either one.
Well, I think it was in our case, it changed a lot of things when the first time we offered ESOP buyback, because in our case we had never launched an ESOP policy formally. So we had employees who came in because it was a bootstrap company. We were paying whatever salaries they demanded or we could afford. And as we went along and we started to raise money, we learned about this ESOP policy. It was the first time we did it, and we could formally launch it for all the employees. So what we did is, when this opportunity for liquidation came about, we opened the pool, we granted ESOPs, and we bought it back immediately. So the morale went really high because, you were not expecting this money. You never planned that ESOPs would be bought back. And then the notion in the market was that ESOPs are just a waste of paper. So what the first ESOP buyback did for us was wonders, because after that, if you would say that, there is this salary, there is increment, and we also want to need ESOPs, ability to pay it fairly seriously. So now, with my founder friends, at least, my advice is that you give salary, you give bonus, and you keep ESOP as the last, incentive, because you don't know if you'll be able to see it through. But your objective should be to ensure that it creates wealth for the team members. How does it work? It works like wonders. Like it's a great tool if used well with the right intent. Like, don't use it as a negotiation tool. At least that's what I think. How did ESOP help?
So two things. Early days, when we couldn't afford to get employees, the way we used to do it was, hey, you're at 15 lakhs, I'll offer you 20, but it is at 13 lakhs of cash and 7 lakhs of equity out of ESOPs. That worked really well until the point when people said, now what happens? This is all paper. And then we, orchestrated that secondary because someone wanted to buy in. To me, that changed the game, right? It's effectively ESOPs are stories, right, within companies. That's all there is. So what you read in the papers, it's not something you see in your bank account. It's mostly a paper that you signed once upon a time. When you have a story to tell, hey, ESOPs have value in this company because there is demand for it, it changes the game. I've heard of all sorts of examples. I think the best I've done is companies that have a continuous upgrowth and valuation can always, every year, every 2 years, do an ESOP buyback plan and allow employees to liquidate up to a certain percent, right? Let's say 25, 30%. So you're giving an unexpected cash bonus, which is a massive delight to somebody. Then the story flows down into their individual houses, right? Here's what I made because of this bonus. And there's also a significant chunk left for future rounds, right? So it also then adds motivation and keeps the team members engaged.
When you don't have ESOPs, you don't have intent to buy it back. And there's so many of our friends only who worked with these large companies and have ESOPs, but they don't know what to do with it.
Yeah, and I think there's a nuance around buyback and secondary, and I'll come to that, but maybe you should.
So I think I've personally lived the ESOP journey because I've been a team member at an early stage company and then we were beneficiaries of the ESOPs. I think the first time I truly realized what these are worth is at the first liquidity event, which in our case happened 8 years into the journey of the company, right? And post that, every appraisal cycle, my wife would ask me, "Ye sab to theek hai, how much ESOPs more did you get?" Like, so I think it's about what the family can do with the incremental capital. So ensuring that periodic buybacks happen, I think is very important for the value of the ESOPs for even those folks who are not liquidating, right? So I think that's very, very clear. The question on whether team members should liquidate or not, there is one nuance there, which is what is the ESOP policy that the company has, right? And most companies have very different what are called exercise periods. So let's say there are companies where on the day that you exit the company, the ESOPs that you have vested cease to exist. So you have to exercise it in the notice period and then sell it and so on and so forth, right? So in which case, if you are at such a company, then by all means, you should take aggressive liquidity, because what if you leave the company, you may not be able to liquidate that stock, right? A lot of pro team companies, what they've been doing is having very long exercise periods. So even if you're not with the company, you can continue to hold those ESOPs. And we see that in the case of a lot of world-class companies that have been built in India, Swiggy, Zomato, etc. All of them have ex-employees of Flipkart, ex-employees creating liquidity because they allowed exercise periods to be very, very long, right? And I think if that is the case, then you need to create liquidity to the extent that your view on the company or your own personal requirements. So I think being cognizant of what the ESOP policy in itself is, I think is very, very important.
And I think nowadays it's good to see a lot of founders spending a lot of time at the inception of the company to figure out what the clauses should be. Itna vesting period hona chahiye, what should be the cliff, what should be the exercise price. Exercise price, for example, there's a lot of discussion and debate on investors and founders on exercise price, because suddenly you become a public company and for 8 quarters you'll have adjusted EBITDA and no PAT because of all the ESOPs that you're distributed. And also on the construct of what happens if you leave, if there's permanent illness, there's death, there's incapacitation, a lot of things, right? And also I think a lot of thought needs to be put as an investor. My goal, or of any investor's goal, is to obviously provide employee liquidity, but also in the most tax efficient and cash flow efficient manner to the company. For example, you mentioned buyback. Buyback obviously results in cash outflow for the company. Generally, the people would want the secondary transaction directly, right? Where there's a just-in-time exercise by the employees, investor light. It's good from a tax perspective, and if there's demand, and then people might get to buy that share. Obviously, there are other complications like investors don't get liquidity preference and different class of shares and rights associated with that. But in some cases, in cash-rich companies, you may not want to get a lot of capital. Different people on your cap table and pull back that ESOP for future grants, right? Where ESOP buyback might be a great option. So there are a bunch of structures, and if any of you are founders and want to discuss some of that, maybe we can take that offline. And there are a lot of consultants who help you also think through what the best way is.
But Anish, I'll tell you, like, one thing which I personally feel very strongly is that a lot of the people working in the startup ecosystem will create wealth via ESOPs. That is the most important asset that they are owning. And yet, the awareness of the structures of how ESOPs vest, are exercised, the taxation around it is very, very poor at this point, right? And I think we collectively as a group need to do a lot of work to increase awareness. The problem because of this is that it's entirely up to the moral compass of the founder to figure out how will I create the ESOPs? Am I being right? Honestly, as founders, because of the information asymmetry or the understanding asymmetry, founders can get away with a lot, right? And I think that's one area of work in the industry that all of us need to do, is to make people more aware of how ESOPs actually work.
Absolutely, agree. And then there have been unfortunate incidents where large amounts of ESOP have actually meant nothing because of...
And if you want more examples, you should ask Anish offline. He has all the gossip.
You should have the conversation, and that's the segue into the next topic on how do secondaries happen, right? Like, let's say I'm a Series C founder, I'm a Series A founder. Boost Series B, C to start taking some secondary, right? People have goals, they have home loans, they need to get a home, they need to get a car, they need to get their kids educated. And these are large expenses which normally you would have saved up for if you were in a job, but you are not in a job. So I think having that conversation with your VC and having some sense of financial planning for the first 5-7 years of the journey. You don't know what happens after that, but at least for the first few years of the journey can be helpful. How do you, Deep and Mohit, have you executed secondaries before your sale? And the sale is a separate topic, I'll come to that. But have you guys executed any secondaries? And maybe Sandeep, you can also add. And how do you think about secondaries?
I think the principle of demand and supply for your shares really landed when we started discussing secondaries, right? Effectively, if you're a startup where there is lots of incoming investor interest and demand for your shares, and then you can actually do a sale, you can orchestrate a secondary, right? If there isn't, and there's one person on the cap table who's coming in now, he's going to put in the money in primary, he will want all of his money to go to the business, right? So a secondary won't be an option. I think smart founders will essentially say at every round, whenever there is more demand than supply, I should take some chips off the table. It can be small amounts, right? It can be, I want to build an estate for 1 year. It can be a bonus. It can be that I want to actually pay off my home loan, and it's a small amount. So I think it makes sense. At Momsco, we never actually did a secondary for Madhika and me. Things progressed quickly to a full sale. That would have been a secondary round. And then the intent was to buy a house, right? We had sold off the houses. We didn't have any. What we did in between, which was secondary for employees, and that's a separate topic. But how the secondaries for employees worked was very early in the second year, we wanted someone to come in. They were happy to buy secondary shares as well. So ESOPs got sold off, they got those. And separately, what that did for us is the idea that ESOPs actually pay back got cemented in the context of the company. So someone bought a clinic, someone bought a car, someone sent off his kids and, paid off an education loan that they had. The benefit for the company at that point of time was that it became much easier for us to hire giving ESOPs because people said, hey, there is demand for the ESOP here. It makes sense. And so our equation of salary, which is cash versus ESOP, changed at the end of that. So we did have some secondary opportunity, but we used it for early employees as well.
In our case, we never did any secondaries before the final buyout.
So nothing for founder, nothing for employees.
No. So, whenever there was an option, we just extended to the angels first. I thought, they were the ones to take the maximum risk in our case. And when there was just one odd event, we thought it's better to, help them go out. And what it did for us, at least, was that when we took an exit, the employees got it at the same valuation. So there was more happiness on the fact that, founders are also getting the same deal. They're not trying to side cut us.
But I know you have something going on. So why don't you tell us how you're thinking about secondaries?
So, founder secondaries are again one of those uncomfortable topics that, how can a founder give up equity? And I think there again, the question is it's only to be comfortable financially. If there are financial goals that the family has, that's the only thing. Obviously, as a founder group, collectively, we have not had a secondary, and I don't think in the foreseeable future we will have one. Having said that, for the team members, certainly, I think a lot of team members are probably working at compensation structures which are lower than what they would get in comparable companies where they are professionally employed and don't get ESOPs, right? So it's our responsibility at every opportunity possible to create a pool of secondary so that people can achieve their life goals. And we actually launched a secondary program. It's another matter that we hardly got any participation. The team chose not to participate and sat that one out. But the fact...
And that became a problem for us because we wanted to buy.
Which became a problem eventually for us because we had to dilute. So I think it's a complex situation. But yeah, I think we let the team members decide for themselves. I think the point is that as a team also, and that's again something that's not talked about enough, is should team members take secondaries? And again, there we strongly encourage our team members to do some bit of disciplined selling, right? If you look at and take the biggest example of somebody who does not need liquidity at all, which is, let's say, somebody like Jeff Bezos, $200 billion net worth, right? What has somebody like that been doing? Consistently over time, he's been monetizing a part of his stake at Amazon. He doesn't need to, right? He has enough cash. He can leverage the stock, etc. But he keeps doing that. With the exception of 2022, in the last 8 years, every single year, he has sold at least tens of billions dollars worth of stock, right? And there's a reason why, right? He's also de-risking at some point. So I think that's something that's a good framework, I think, for every team member to apply, is that at every opportunity, create some liquidity for themselves.
Why doesn't that apply to Indian founders as well?
I think it's the stage of the company, because that is the most expensive equity. And when we're talking about unlisted situations, right? The stage of the company that you're giving up equity at is probably the most expensive equity that you're giving up, right? And if you're comfortable financially, then the question of regret minimization, right? Because at every stage, there is a sense of regret that I am in control of affairs here, and yet I've monetized and I knew that the company is scaling. So I think most founders have struggled with that.
Yeah, it's because, it's interesting you say that because my philosophy is the opposite. And I've spoken to founders. It's the same thing, right? You never know when tables turn, right? So imagine if you had 3 potential rounds of secondary before COVID hit. And in COVID, because of externalities, your business had to shut down, right? You're still 100% risked. So from a de-risking perspective, even if you have wealth, I just think it makes sense to take nominal amounts off the table so that you're building more of a nest egg.
No, I think sure. I think the mental comfort, the amount that lets you sleep well at night is very, very crucial. And that's the first step. beyond that is the real question, and that's something that I think most founders.
But if you see, traditionally Indian promoters were, if you look at the BSE and NSE listed space, even after listing highly profitable companies through cycle, promoters owning 60, 70, 80% non-diluting. I think that has changed in the last 2, 3 years. If you look at the data, I think last year somebody was sharing those numbers, $10 billion of promoter liquidity in the last 12 to 18 months. So even listed promoters are sort of liquidating their positions and getting cash out. Now, one can argue it's a change in perception. One can also argue they think that the valuations have capped out and it's a good time to take out money. But, when founders sell, there are a lot of signals around it. So you have to also be careful. How are investors thinking about it? What signal does it give? Especially if it's a public company. How are
The way to do it is create a situation where there's lots of demand. You pretend like you really, really desperately don't want to sell, but you sell a little.
yeah.
Anish also doesn't agree.
No, it happened. No, I actually don't have a point of view because I'm not a founder. So I'll give you the extremes, right? We have founders in our portfolio. Whenever they get extra cash, they actually go back and buy stock. And Sandeep is also buying some more stock in Dezerv. Okay, moving on to wealth creation and portfolio managing, the most interesting part. How did you allocate? So if you can share numbers, that's great. If you can't, that's completely fine. But even percentages are fine. People generally Sandeep used to tell me, people make the worst decisions when they see large amounts of money, right? Because हाथ में पैसा आ जाता है, suddenly you start feeling very nice, and then you take the worst capital allocation decisions. Maybe a little bit of both of your journeys. What was the sale? Again, up to you on numbers. How did you allocate the gains made from the equity sale? And also a little bit about how was your portfolio, non-company portfolio, being managed? Were you managing it? Was there a wealth manager? कैसे था approach before the sale?
Yeah. Before the sale, I had no portfolio. So that's easy, right? During the sale, I had two really interesting conversations that I think changed trajectory from then to now. One was that during the sale, we had an option of cash or equity in the company, right? Of course, in the acquiring company, equity has a significant upside. So that's an interesting way to look at it. At that time, it was also cash rich. There was a lot of cash coming in, and we had demand. We had 4-5 people on the transaction. So we had the option to take all cash. Really interesting. I met a wealth manager at that point of time who asked me one question saying, you know everything about diversified portfolio, etc., etc. How much of your family's wealth would you want to put in any one stock? Right? And that to me was such a powerful question because instantly my answer was no more than 8-10%. And so the question translated to Malika and me both being in the company, owning the shares. How much of our wealth would we want in the acquiring company where we have no control, right, after acquisition? So it is the way we transacted that was we did all cash, right? It came out in tranches over time, etc., but it was an all cash deal. And so we took no equity, allowing us to then diversify everywhere else. The second thing that happened was actually the news leaked in October 21. It came out in press and the transaction closed in December. So between October to December, thankfully what happened was every person who is a wealth manager or any company reached out saying, you have lots of money, we want to meet. Which was fantastic because given that I had no portfolio before, I used it as a learning opportunity. I met everybody. I learned from everyone. Then I went with no one. Then I went with a friend who runs a private wealth company. So for me, it is essentially what I do today at DVC as an angel investor is very, very high alpha, right? It is high return, high risk. So all of my risk return is parked on this side. My entire other portfolio is very, very simple. I've allocated now, move money out for LRS, whatever's possible every year. That gets diversified across US, Europe, etc., etc. The wealth manager doing that. I have in India, and India, my portfolio is now, 60-70% equity, mostly large caps. Rest of it is debt. So very simple diversified portfolio. And then a decent 10-15% chunk of the wealth we have is in private equity or is in private angel investing, LPs in funds, etc., where I have no control, right, effectively on when it comes out. So the way I've looked at it is we made enough money that, us and kids will be happy and all needs will be taken.
When I said portfolio, I meant real estate also.
Oh, yes. Okay. We put a significant chunk in real estate, which has become now 2.5 times. So we were lucky.
You should ask him his address so you'll know the answer to it.
So we were lucky there. So this is the right? The non-real estate side of it. It's only the one house we bought. We didn't invest anywhere else. And then it's just massively diversified. A decent chunk of that diversified is actually with Dezerv now.
Deep, what about you?
So I think when this episode took place, we decided to solve for two things. We said, one, we need liquidity for everyday expenses. So we made a list of it, that there is these things we need to solve for the next 5 years, 10 years. I don't know when am I going to start again. So we put all the obligations, the fees, all the debt, whatever we had on our assets. We said we'll first retire all of this. So I would say 10-15% went towards retiring each and every EMI that I was paying. I said it's all gone. Then we said we need to create enough liquidity to meet these ongoing expenses that we have for the next 5 years. That was put aside. And after that, it was real estate, which is about 20%. I took 20% away for my startup investments. And remaining is with my wife and my brother.
Did you buy a new house
Yeah, one.
after the sale?
Yeah, one more.
Sorry, last part I missed. The remaining was?
Is with my wife and my brother. So yeah, it's in
That's
better
not a
hands.
bad wealth management strategy.
No, so I think the 20% I'm talking about, that's the amount that I set aside to say this is the amount that I'll only use for startups. And within that, initially I started, of course, investing in a lot of startup smaller checks. But by the time I'd invested half, I figured out my thesis is I love to work with the founders. And hence, I'll invest now in fewer companies, but I'll start giving it more time. Yeah, larger stakes, more time. So that's where most of my time is going. So what I'm tracking is this 20% has to beat the 80%. So yeah, that's the game.
What about you, Sandeep? What did when the 360 IPO happened, when the you were able to get liquidity out of your ESOPs? What were some financial decisions that you took?
That is the time I read about Jeff Bezos' disciplined selling. So I said, we'll do it over a course of time, because in our case, what happened was the stock went public. So overnight, we could start liquidating whenever we wanted to. So when you have that kind of situation, it's almost like buying the stock on every day, right? Every day you decide to hold a listed stock is a day you're deciding to buy that stock, because theoretically you can sell it, right, at any point. So what we did was, and Sahil, Weber and I, we had a similar philosophy that over a period of time, we'll gradually keep reducing our exposure to this position. And honestly, there was no right answer as to why we didn't do it all at one go. Maybe there was a little bit of that thinking that I'll have to pay all the tax upfront, because the moment you sell, advance tax kicks in, and then you'll have to create liquidity for all of that. So we said we'll do it over a period of time, and that was a gradual diversification. The problem was, right through this entire process, the stock kept going up, right? So every time you sell, you remember that the पिछला lot जो बेचा था, you're already in a loss for that. But that's something that you have to live with.
Yeah, but I think selling in a disciplined manner and allocating large gains in a structured portfolio, those are the two hardest risks. Because even if you ask professionals, March and December are the times when they make the worst financial decisions, because you're getting large bonuses if you're in professional services, or annual performance bonuses. If you're in a sale event, you get a large chunk, you don't know what to do with it. And then all new sorts of hobbies kick in, like, for example, angel investing. A lot of people ask me, should I angel invest, right? Unless you're really willing to give that time and effort. But yeah, I think what you do as part of that portfolio, and what do you advise when you meet promoters? Right? You've obviously seen new age founders, but this is a problem you've seen for 15 years, right? People sell 5,000 crore businesses. What do they do with 5,000 crores?
So Anish, let's imagine the persona of a founder or a promoter, right? What is this persona? This persona is somebody who's hyper-focused, super optimistic, concentrated, wants to do what they want to do. So they are a founder who's done secondary is a wealth manager's delight and a risk manager's nightmare, right? Because they come with strong opinions, right? I have a very bullish view on the economy. I want to put all my money into small caps, right? And then, like, you had that conversation where you're saying that, okay, how much risk? So we try and tell them that what is the downside that you can tolerate? And these are founders in most cases who come from nothing, right? First generation wealth creators. वो them वो भी नहीं समझ में आता because they're like ठीक है what is the worst that can happen, you know, I will start a new thing all over again and no problem. So I think that's the issue that we face, that explaining risk management, explaining that now that you've taken risk to create this wealth, the job of us as a collective unit is to manage it. We can't now grow it the same way that you had created this wealth in your past, right? And therefore, distancing the wealth management from the wealth owner is very, very important, right? And it can happen. Your spouse can manage your money, your friend can do it, a wealth manager can do it, a banker can do it, whoever. But distancing the wealth owner from the wealth management is very, very important. It's too important to keep that very objective. And you're almost then assessing your wealth manager as your team member or as an employee, right? You have certain KPIs, whether the wealth manager met those KPIs, and what did you compensate that wealth manager for meeting those KPIs, is the framework that I like for founders to take, as opposed to trying to do it entirely themselves.
I'm imagining him having a conversation with his wife, say, "You haven't met your KPIs."
No, but I think Sandeep is making an important point. You need a dispassionate approach to managing that money, because 20% down on a 1 crore portfolio is 20 lakhs, 20% down on a 5,000 crore sale portfolio is 1,000 crores, right? So I think some of these sheer numbers, when you're handling large amounts of money, sensitivity of small decisions sort of make it all the more important for you to have separate the process. You know, somebody told me when you become rich, you're focused on wealth preservation more than wealth creation. Many of us in this room are in the wealth creation phase, but for people like the people sitting on the right side are more in the wealth preservation plus creation mode. So that requires actually a very different approach versus trying to bet in every other small cap stock, you see. So I'm going to stop here.